Hey, hi, morning, Tony. It's been an interesting year so far. We're entering into the fourth quarter and it looks a lot busier than usual. The Fed just announced start rate cuts and we have US election in November. So what does this mean for equities, bonds, and currencies in the short term, especially towards the end of 2024?
Hi, Shankar. Yes, thanks for that question. And I think you're right. After what's been a pretty good and steady year so far this year, which, by the way, you and I have been talking about this all year in these conversations, and we've been highlighting that we expect global growth to be pretty solid, inflation to moderate, and that stocks and bonds can do well this year. And I think that's really panned out very well so far. But as we get to the fourth quarter, we are starting a number of transitions. So I think to your question on the various markets, for the most part, we think equity should be okay, but probably a little bit sort of slower returns compared to what we saw in the first three quarters into this final quarter. And bond markets have done well as we've been talking about rate cuts, and bond yields have been moderating, allowing bond prices to go up. We're a little worried that maybe they're overpricing too many rate cuts, but still, this is a healthy backdrop that we're talking about rate cuts as opposed to rate hikes like we were in prior years. And then finally, on currencies, there's a lot of adjustments going on as bond yields around the world have been adjusting. We do see that, especially like the U.S. dollar, which has been very strong over recent years, does look like it should be sort of more moderate and even maybe a touch weak, given the fact that the US is probably going to be leading the world in rate cuts.
Thanks, Tony. That sounds really, really interesting. Looking further out, especially towards end of 2025, where do you expect the US interest rates to land and which global sectors do you favor?
Okay, yeah. So especially, I think I maybe just expressed some caution on the fourth quarter itself, but really when you look over the course of the next year, I think our view is that we see continued global economic expansion, albeit maybe at a little bit slower rate than we've been seeing the last couple of years, but at the same time getting rate cuts. And this is a healthy backdrop for investing, and we think this should look like some of those rate cut periods where you've had continued expansion in the past. And so, for example, 1995, 1998, 2019 are the types of environments where we've kind of had this backdrop. And those were good years for investing. I would say that the type of rate cuts you get in those sort of expansion periods with a bit of adjustment in interest rates is that you tend to get more like 75 to 100 basis points of rate cuts, where the market's pricing more than that right now. And so maybe the market might be a little disappointed if it's not quite as aggressive as that. But for the most part, my main message would be this tends to be a period where investments can do well. And I guess on your specific question about where interest rates might land, I guess our view is to expect probably something around the neighborhood of like six rate cuts, where I think the market's pricing something like 10 rate cuts. And in terms of where to invest in the coming year, I do think global markets will do well on in this backdrop, and I also see sort of better breadth of investing. That the performance really still over the last year has been a little bit overly tech focused, and I think more industries will participate in it over the next year.
One of the markets that generally benefit from rate cuts has been emerging markets. And let's home in on Asia. Which Asian markets do you expect to benefit from the falling US interest rates?
Okay, in the last year, the areas in Asia that have done well really have been those that have been most focused on tech and semiconductors. So it's like Taiwan, parts of Korea have done really well. I think in the next year, as interest rates get cut, I think actually the types of areas that benefit the most are actually more like the South Asian countries, and in particular, ASEAN. During periods of interest rate hikes, ASEAN frequently struggles, and in the past it's been called things like the Fragile Five and stuff like that. But as interest rates are going to get moderated, and the fact that growth around ASEAN has been okay and stable and doesn't really show any signs of falling into a recession, I think that's going to make ASEAN quite attractive. And as in times when interest rates go up, it tends to be an underperformer. And I think it's going to be one of the outperformers in the coming year.
That sounds exciting for Asia. However, both Trump and Harris are likely to try to limit China exports to the US. How damaging is this for China?
That's right. It does look like politically, the U.S.-China tensions are going to persist no matter who wins. I do think markets are a little bit on the lookout in the case of a Trump victory. I guess there is an expectation that that tension probably even gets ratcheted up more dramatically. But either way, it looks like it remains a headwind. And in itself, China has enough strengths that we might be able to look beyond it. But for the most part, what we're still dealing with in China is, still a lot of rebalancing around the property markets, still a lot of sluggishness in the domestic markets. And therefore, we've had China as an underweight, and we see lots of interesting opportunities. And we would be really eager to raise weights in China, but given the headwinds and the fact that the growth really hasn't turned around yet, we still end up being concerned and underweight about China, and think that the political tensions are probably just going to become an additional headwind that it'll have to deal with.
So finally, for all those investors who are reviewing their investments portfolio towards the end of the year, what is your advice to them? How should they rebalance their portfolios?
Right. So I think, one big theme that I think you and I have been talking about in these chats for the last year plus is that we've seen clients have been sort of overly concentrated in cash after, some scary years back in 2022 and so forth. So I think we've been encouraging that really over the last couple of years, stocks and bonds have been outperforming cash. And that's about to get, all the more of an issue as the central banks around the world cut interest rates. Whatever you're seeing at your banks right now, it's going to be declining in the coming 6 months. And therefore, we would, encourage investors to continue to diversify your portfolios, get invested across stocks and bonds. And then more specifically, I guess, some big themes we are highlighting is we do believe in better breadth in the global equity markets. We think it's probably going to be more than just the tech companies that are performing. I think there's opportunities in healthcare and financials and industrials and consumer companies. And as we track earnings growth forecasts for the next year, the earnings growth does look like it's diversifying to those sectors. And then within fixed income, we still think that that the big risks of rising rates are behind us, and that fixed income still offers opportunities to sort of take on higher duration than we've taken in the past, and that these will be nice, safe assets, especially if we get sort of later into a cycle and growth eventually starts to slow at some point over the next couple of years. So I think there's lots of opportunities out there, and the main message is to not be sitting on your hands, and to explore what are really a lot of exciting ideas out there.
Tony, we talked a lot about the positives in the markets. What are the concerns, if any, do you see in the markets currently?
There's always risk to markets, and the fact is, we've been arguing that we see this global expansion continuing. But it is fair to note that, this cycle is getting more mature the longer it goes on, and cycles don't last forever. So, on our team, we spend a lot of time analyzing, do we think we're at the end of this cycle yet? How do we think the end of a cycle might look like, and so forth? And so there's always risks around that, and we spend a lot of time thinking about it. I would say one part we tend to think a lot about is if we do get to an end of cycle sooner than we're expecting right now, there are a lot of reasons to think that whatever recession we may get would be of a softer variety. We don't have the type of, big excesses that we had after like the dot-com bubble or after the housing bubble. And therefore, there are recessions in history that tend to be more mild and last over a shorter period of time. And I do think, therefore, we should be on the guard that, end of cycle might come soon. But at the same time, I don't think we have to be completely paralyzed by it, because it doesn't have to necessarily be that deep or that long.
All right. Thanks, Tony.
Thanks, Shankar.